Afternoon, everyone. My name is Karen Weeks with the League of Women Voters, Sonoma County, and our speaker today is Mary Fricker. Um, First, I'd like to say a couple of housekeeping items, and if you could please mute your audio and turn off your camera, that would be great. So, a little bit about Mary. Mary is an independent business reporter who has retired from the Press Democrat. She freelances and also publishes the www.repowatch.org, which tracks the repurchase market or repos and shadow banking, and which won the Best in Business 2012 award for digital blogs from the Society of American Business Editors and Writers. In 2010, she received the McGill Medal for Journalistic Courage from the University of Georgia for her work with the Chauncey Bailey Project in Oakland, California. And you can find more about that by going to www.chaunceybaileyproject.org. Among her other awards are 3 Investigative Reporters and Editors Awards, the UCLA Gerald Loeb Award, the George Polk Award, several New York Times Company Chairman's Awards, the National Headliner Award, and Associated Press and California News Publishers Association Awards for Business Reporting. And if you've been a longtime reader of the Press Democrat, you will recognize Mary's name. And if you are like me, you've enjoyed reading her over the years. So with that, I will turn it over to Mary.
Hello, everyone. Do I do my sharing now?
Yes, please.
Here we go. Great. It's working. Thank you. And thank you so much for having me. Especially thanks to Leona for inviting me. Leona, I really appreciate it. I've been a business reporter for 40 years, and I'm worried. America has become a land of unequal opportunity, where the wealthiest 10% of Americans get half the nation's income, and they have 2/3 of our national wealth. Why? A key reason is that for 50 years, both parties in Washington have been deregulating finance. This has caused 2 big problems. Our rich are getting super rich, while middle Americans feel stuck, and our financial markets are unstable, dependent on frequent Federal Reserve bailouts. In my remarks, I'll outline how finance is placing us in peril, and I'll propose 9 simple, nonpartisan steps that Congress can take to start getting America headed in the right direction again. Our timing is good. Both parties say their number 1 goal is to help middle Americans. Okay, great. Prove it. It's time to move beyond the blame game and get busy. We can do this. So, what went wrong? It all started 50 years ago. The 1973-75 recession was the worst since World War II. Congress's response was to try to goose the economy by slashing regulations on finance. Congress lowered taxes and regulation to free up money. And after Americans chose Ronald Reagan in 1980, the effort escalated. It continues to this day. And with that money, financiers have created a world that many Americans never see. A world that makes a lot more money for its insiders. Today, finance, which has 4% of our employees, gets $23 of our nation's profits. And in 30 years, we've had to bail them out 8 times to protect our economy from the collapse of their risky deals. What is finance? Finance is banking and investing. A financial company is a company where the product is money. Banking and investing companies are essential to our well-being. But the unseen universe of finance that Congress has let them create since 1980 is not. In that world, giant financial firms, sometimes called shadow banks because they're not as regulated and transparent as banks, lend, borrow, buy, sell, invest, speculate, hedge, and gamble with each other and with banks, creating an interconnected web of risky deals. Who are these shadow banks? Here's a list. Money market funds, insurance companies, pension plans, hedge funds, and so on. Just about anything that borrows and lends but isn't a commercial bank. Every day, these shadow banks conduct trillions of dollars of deals. For example, every night, they make $3 trillion in so-called repo loans to each other. And those repo loans have to be paid back the next day, unless the lender rolls them over for another day. Repos are the unseen money that finances the unseen financial markets I'm talking about. I blog about repos at repowatch.org in case you're interested. Repo loans are why we crashed in 2008. A giant bank, JP Morgan, suddenly demanded repayment of its repo loans from Lehman Brothers. Lehman Brothers couldn't immediately repay, and it failed. So what? Companies fail. That shouldn't have been a problem. Except deregulation of finance has let financial firms get so interconnected with deals that failures quickly spread. Before Congress deregulated finance, only regulated and self-insured banks with FDIC insurance could do the riskiest business. To this day, banks have to pay for their own bailouts with their FDIC insurance, which they themselves pay for. But now shadow banks with no insurance and not much regulation can do the risky business too. That's why the Federal Reserve, which used to have to be responsible only for banking, now also has to babysit the volatile world of investing, which has grown 3 times bigger than banking since the 1980s. Many experts say that this unseen world of finance is a driving force behind the rise in inequality in the US that also began in the 1980s. They say that years of rising inequality is a key sign of a coming market crash. And sure enough, in 2008, we had the first economic crash since 1929. In the Great Recession that followed, more than 8 million Americans lost their jobs, and the net worth of American households fell by more than $10 trillion in less than 1.5 years. The Federal Reserve and other regulators shoveled trillions of dollars into financial companies to stem the losses, and soon finance was back in business. But for many on Main Street, the economy still languishes. And today, inequality is soaring once again. Since that 2008 crash, Americans have been pleading for help. The Tea Party, Occupy Wall Street, bouncing between Republican and Democrat presidents, landing most recently with President Trump, a strongman. All have been signs of fury. Angry Americans know something has gone terribly wrong. From housing to healthcare, our communities are deeply impacted. Yes, globalization, technology, the pandemic all played a role, but something else isn't right. When an economy is overwhelmed by finance, that has a name. It's called financialization. In the US, financialization must be unwound. So today, what worries middle Americans the most? Many studies show their biggest worry is finding and keeping a good job. And deregulation of finance has cost us good jobs in many ways. For example, companies have discovered that with today's laws, they may be able to make more money by moving money around, by lending, borrowing, and trading, than they can make by producing goods or services. General Electric was one of our nation's greatest creators and producers for decades. But in the 1980s, GE management started GE Capital, a bank. It went into credit card lending, mortgage lending, insurance, sales, and real estate. It grew to account for almost 2/3 of GE's profits. In 30 years, General Electric eliminated 158,000 US jobs, almost half of its domestic workforce. GE stock price soared. Executives, shareholders, and finance wizards loved it. But in 2008, finance had a crisis. Today, the iconic GE is gone, broken into lots of parts, and thousands of jobs have been lost. Here are 3 other quick examples of how finance and its focus on money have hurt jobs. 1, many companies and the wealthy, while enjoying the multiple benefits of being in the US, take profits and jobs to tax havens abroad to avoid taxes, a dodge that has accelerated significantly since the 1990s. 2, executives often use profits to buy back their company's shares and enrich shareholders, instead of using that money those profits to increase production or employees' wages and training. And three, investors today seem to love those private companies that buy other businesses, lay off those employees to reduce costs, and sell the equipment and real estate to make a quick profit. These things do make me wonder how much of our loss of jobs is caused by illegal immigration and globalization, and how much of it is really caused by financialization. A key benefit we have today is the Federal Reserve, which is much better equipped to fight economic panics than it was in 1929. The Fed's financial market bailouts today protect Americans from much bigger crises. But there are big downsides. Number one, bailouts are a subsidy for the rich that promote inequality. Regulators pour cash into Wall Street, not Main Street. A second downside, bailouts encourage risk-taking because speculators know the Fed will swoop in and save them, so why not make risky trades in hopes of getting rich quick instead of investing in boring old Main Street? A third downside, bailouts threaten the Fed's credibility. Americans begin to suspect the Fed only cares about the rich. The Fed's not perfect. It has made mistakes. But if it loses credibility, that will be a disaster for Americans who depend on the Fed to control inflation, support jobs, and prevent financial crises. And a fourth downside, bailouts are a big financial hit to us, the American taxpayers. That's because when the Fed makes a profit, it gives that profit to the US Treasury, to us. Often about $10 billion a month. But because of the bailouts, the Fed is losing money for the first time in its history. And it stopped making monthly payments to the US Treasury 3 years ago. So far, that's a potential $360 billion that we don't have to help us finance our federal budget. And that $10 billion monthly shortfall continues. But that doesn't have to be the end of the story. I'm going to give you 9 specific fixes that Congress can do. Things that came up repeatedly in my research that are easy to understand, simple to do, and used to be normal in this country. And even if we only do some of these fixes, we win. Main Street and Wall Street will be working together again. So let me start with some perspective. For 50 years, while Congress was passing hundreds of laws to encourage more robust financial markets to help Wall Street, it also passed legislation to help Main Street. Over these years, living standards for most Americans have improved. But the benefits to Wall Street have far exceeded the benefits to Main Street. One main engine of this inequality is investing. Americans who invest in stocks, bonds, and/or real estate often have far outpaced those who don't. thanks to financialization. As we choose the steps we can take to start to even the score for non-finance Americans, I believe our solutions need to meet the following 6 criteria. First, equal opportunity for all Americans. I'm not targeting help for minorities or the poor or the rich. I'm not proposing handouts for anyone. I'm not demonizing the wealthy. They're often hard workers who rose from a blue-collar background and contribute significantly to our communities. Americans generally don't mind if the wealthy do well. They just want fair opportunity for themselves. That said, I am mindful of the power that big money seems to have in Washington. Let's call on Congress to remember the wise words of investor Warren Buffett when he told politicians in Washington to stop coddling the super rich. The second thing to keep in mind is business. Generally, Americans support business. Many prefer and trust business over government. They know the importance of small businesses, and they're fine with big business if it benefits all of its people, not just executives and shareholders. But when they learn that CEO pay was 31 times a typical employee in 1978, and today it's 281 times a typical employee, they feel cheated. The third thing to keep in mind is financialization, because finance benefits everyone if it's properly aimed. When the value of our savings goes up, when we qualify for a mortgage, when insurance covers our accident, when our school raises funds through a bond sale, when we can retire. In these and many other ways, we benefit from a healthy finance industry. My fourth thing to keep in mind is we need to simplify. The Glass-Steagall Act that regulated banking in the 1930s was 37 pages. And it kept American financial markets stable for almost 70 years. The Dodd-Frank Act in 2010, after the 2008 crash, was 2,319 pages, and it has not prevented financial crises. The bailouts continue. Fifth, to keep in mind, we need to reduce our federal debt. This year, it's expected to cost us $1 trillion just to pay the interest on the Treasury securities that we sell to fund the federal government. That's triple what it was just 5 years ago. So this is not a time to cut taxes. I must say, though, it's kind of ironic that we sell those Treasury securities to investors, people with money, and then we have to pay them the $1 trillion in interest every year. And finally, the sixth thing to keep in mind is accountability. We must track whether our fixes are working. And as we choose our fixes, we can learn from history. Many experts have noted the stunning similarities between the 1920s and the 2020s. For example, as I mentioned, today the wealthiest 10% of Americans get half of all of our income. In the 1920s, it was the same. But after the 1929 crash, those 10% fell to only getting a third of our income by the 1970s. Then Congress started financializing, and now the wealthy are back up again. Some historians tell us that the 1920s and the 2020s phases of rising inequality are inevitable as economies mature and the wealthy prevail. Some say the only way to reverse this is with a war, a French Revolution, a 1929 crash and depression, or government intervention like the New Deal and the Marshall Plan. Congress, are you listening? The 1920s and 2020s are similar in many ways. Finance is deregulated. Wages stagnate while fortunes soar. The same JP Morgan bankers are prominent. Financiers are doing the same risky trades. Our country is isolationist, and many troubled people are finding comfort once again in anti-Semitism, fascism, and strongmen. In the two periods, we've even tried the same ineffective fixes, launching tariffs and ejecting immigrants that failed to prevent the Great Depression. I will propose 9 effective fixes. So let's start by talking about fixing banking. Bring back Glass-Steagall, the act that used to regulate banking, would be a good summary. And guess what? Both Republicans and Democrats have said in recent platforms that they want to reinstate Glass-Steagall. So do it. The Glass-Steagall Act was passed in 1933 and gutted in the 1990s. During those almost 70 years, regulators were able to manage financial crises without bailouts because panics didn't spread throughout the financial markets. Think about the crash of the savings and loan industry in the 1980s, in which more than 1,000 savings and loans failed. But no financial market bailout was needed. But since 1998, as I mentioned, U.S. regulators led by the Fed have had to step in 8 times to prevent a financial crash. If you weren't aware of these eruptions, it's because they happened in that unseen world of finance I've been talking about. This was predictable. As a colleague and I told Congress in our congressional testimony in 1991, quote, if Congress allows banks to be owned by non-bank companies, to underwrite securities and insurance, and to operate interstate, it will unleash on the nation a second financial holocaust, which will make the costs of the first one, the savings and loan crisis, look like chump change, end quote. We were right. The same crisis cost us $153 billion, not including Americans' personal losses. The 2008 crisis cost us $600 billion. What's the next one going to cost? The return of just 2 Glass-Steagall provisions would greatly stabilize our financial markets today. So I want to, number 1, stop too big to fail, and number 2, keep deposits at banks. My fix number 1, stop too big to fail. We have 4 banks that each has more than $1 trillion in assets. JP Morgan Chase, Bank of America, Wells Fargo, and Citibank. Back in 1981, before financialization, Bank of America was our biggest bank, with about $400 billion in assets in today's dollars. Today, the largest bank is JP Morgan Chase, with $4 trillion in assets. Think about that. Do you know what $1 trillion is? Spending at $1 a second, it would take you almost 32,000 years to spend $1 trillion. And JP Morgan has 4 trillion. These 4 banks are also among our riskiest banks, according to regulators, and some of them are not very well behaved. JP Morgan, for example, is a 5-time felon. Obviously, these banks can do what they want. We can't let them fail. My proposals will change that. I propose to return to the simple Glass-Steagall provision that separated banking from investing. No exceptions. Investing is risky with hedges, derivatives, shorts, puts, options, calls, and all that stuff. Why let it interact with banks that the rest of us depend on for our financial stability? Congress also needs to set a limit on bank size, because big is so powerful in finance that it will inevitably grow too big to control. The Independent Community Bankers of America, a national banking group, has said that banks with more than $100 billion in assets are too risky. Okay, fine with me. $100 billion is big enough. By the way, I hope that one benefit of my proposals will be a refocus on community banks. Both parties agree the community banks do a better job of serving Main Street than do the giant banks. But since we started financializing, the number of U.S. banks has fallen from more than 14,000 down to fewer than 4,000. Bank branches are at their lowest level since the 1980s, and rural communities have especially been hurt. The Independent Community Bankers of America, that national banking group, said, and I quote, "The greatest ongoing threat to the safety and soundness of the U.S. banking system is the dominance of a small number of too big to fail mega banks, which are too big to manage, too big to prosecute, and their executives are too big to jail." End quote. My second bank fix My fix number 2 is to fix deposits. Let only banks or credit unions take deposits, and all deposits have to be insured by the FDIC or the NCUA, which is the credit union equivalent of the FDIC. Why? Because deposits are dangerous. Okay, heads up, everyone. Deposits are so dangerous that many experts say this is the most important fix we can make to protect Americans from a financial panic. In my 40 years as a business reporter, this is what has scared me the most. Deposits are dangerous because depositors can demand their money back whenever they want, right? Even though the bank may have loaned that money to someone else and no longer has it. If a bunch of depositors get freaked out for any reason at all and start withdrawing, that's called a run on a bank. And it's very destabilizing, not only to the bank, but to all financial institutions connected to that bank, especially these days when all players in financial markets are interconnected by deals and when rumors travel worldwide in nanoseconds. That's why the Fed has to step in. All financial panics are caused by runs, period. That's why Glass-Steagall said only banks can take deposits. Banks have ways to deal with runs. But with the overturning of Glass-Steagall, we now have a lot of investors that are putting various kinds of deposits with shadow banks. An example is money market funds, which are shadow banks that take deposits from investors who can demand their money back anytime. Under my proposal, money market funds will have to be regulated like banks or make a different agreement with their depositors. By the way, I'm not talking about money market accounts at banks, which usually have FDIC insurance. Other examples of dangerous deposits that, by the way, are soaring these days are stable coins and the repo loans that I blog about at repowatch.org. If we bring back just these 2 Glass-Steagall provisions, separate banking from investing, and let only banks take deposits, then speculators won't be in banks. They'll be over there in the free markets. Great! That's exactly the right place for capitalism's creativity. Investors make and lose billions of dollars over there every day without causing international meltdowns. Today, a key goal of Treasury Secretary Scott Bessent is to stop bailing out the financial markets for all of the reasons I have discussed. Excellent. But first, Congress must enact my bank fixes. If not, I fear a run on giant shadow banks and another 2008 crash. Now I have 4 proposals to fix taxes. Over time, when Congress made major changes to the tax laws to benefit people in finance and to stimulate the economy, the idea was that wealth would trickle down. It didn't. Even Will Rogers knew that in 1932. The result is that the well-to-do don't carry their share of the nation's financial burdens. That's true, even though our income tax rates are progressive. The rich pay a higher tax rate on their higher income, and many lower income people don't pay income taxes at all. But if they work, they do pay payroll taxes for Social Security and Medicare. I will propose 4 tax fixes that will increase taxes on some wealthy, but not by taxing them more than middle-class Americans. So my fix number 3 is to fix income taxes. I propose that the personal income anyone gets above today's standard deduction will be taxed at the same rates, whether it's salary for employed Americans, capital gains for long-term investors, dividends for shareholders, carried interest for investment fund partners, foreign earnings for international operators, stock options and bonuses for executives, tax-free bonds for investors, or anything else. These are among the many ways Congress has reduced taxes for the wealthy. Get rid of them. On the other hand, no income taxes would be owed on investments that gain in value but that you don't sell, just like no income taxes are owed on a home that increases in value but that you don't sell. No income, no income taxes. Simple. My fix number 4 is to fix payroll taxes. We must preserve Social Security and Medicare. So I propose that the wealthy pay the 15% Social Security and Medicare tax on all of their income. The maximum annual wage that pays payroll taxes today is $176,100. So while most of us have to pay payroll taxes on all of our income, the wealthy can earn millions of dollars that isn't taxed. The rich and powerful have plenty of money. They can afford the same tax burden as blue-collar Americans. My fix number 5 is to fix business taxes. Over past decades, Congress has given businesses zillions of tax deductions. They're too complicated for me to untangle. So I propose to tell companies, okay, you can take all the deductions you're eligible for, including foreign profits, depreciations, past losses, 199As, research and development, and so on. But first, before any deductions, U.S. businesses of all kinds and sizes would have to pay a minimum 15% annual tax on profits. No matter if you're a C Corp, a pass-through business, an S Corp, an LLC, a partnership, a limited partnership, a sole proprietorship, a REIT, a family office, or who cares, no matter if the income comes from the US or Timbuktu, the company would pay a minimum federal tax on profits. Simple. After all, income tax rates for individuals for 2025 are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Shouldn't companies have to share that burden? The Supreme Court says companies are people, right? Internationally, 137 nations support a 15% minimum tax on business profits. Sounds good to me. My last tax fix, my fix number 6, is to fix the IRS. I would require that the IRS spend half of its time auditing the wealthiest 10% of our people. Why? Because the wealthiest 10% get half of all of our income. The IRS has to go where the money is. Generally, the IRS audits lower income people the most. And that's it for my 4 tax changes. To be clear, I am not criticizing people who benefit from these tax laws. I have benefited from some of them myself. There was a time when some of these tax provisions made sense, and maybe someday they will again. But not now. Now, quickly, I see 3 other simple fixes that would help bring Americans together again. So my fix number 7 is to fix stock buybacks. Stock buybacks, when a company buys back its shares, were illegal until 1982 because they were viewed as a way for a company to drive up the value of its stock. A pivot back to that standard will be easy. Buybacks have soared in recent years, reaching record levels. For example, the 2017 Tax Act said companies could bring foreign profits back to the U.S. at a reduced tax rate. The purpose was to lure money back to the U.S. and stimulate our economic growth. Great. But guess what? Analysts found that much of the returning money and savings in taxes went for share buybacks, not for employee wages or training or product development and sales. My fix number 8 is to cap annual interest on credit card debt at 10%. I'm encouraged by the bipartisan agreement in Congress right now to do exactly this, but it's stalled. Just do it. After the Great Depression and World War II, most states had caps on the interest that lenders could charge on a loan. But in the 1980s, Congress phased them out. Meanwhile, the wealthy can often borrow money for free in that unseen world of finance. And finally, my fix number 9 is to fix bankruptcy court. In 2005, Congress passed a bankruptcy act that it should just repeal. We did fine until 2005 without it. Bankruptcy law in America used to reflect our belief that honorable people willing to work hard deserve a second chance. But in 2005, powerful players convinced Congress that people were abusing the system. The 2005 law made it harder for individuals to file bankruptcy. It became more complicated for a homeowner to be relieved of mortgage debt in bankruptcy. And student loans became one of the few debts that usually cannot be discharged in bankruptcy. For most, unpaid student loans became a lifetime burden that often keeps growing and that will never, ever go away. But the 2005 law lets key lenders get their money out of bankruptcy immediately. That is financialization. And that's all, folks. 9 specific steps Congress can take to bring us together again. Everything I've said today is in a 40-page paper I wrote that has a lot more detail, hundreds of my sources, a couple more fixes, and a list of the bailouts I've mentioned. Give me your email after this talk and I'll send you a copy. Leona referred me to a great article about financialization of healthcare, which I have added to my paper. If you have other ideas for fixes, I'd love to hear them. Thank you.
Thank you so much, Mary. We really appreciate it. And if uh, members of our audience, if you would like to put some questions in the chat, we have time for a few questions for Mary. The first question we have is, how can we get Congress to do any of those great ideas you shared with us? Do we write them daily? One idea a day?
Yeah, Congress hasn't done much of anything for about 30 years, right? But you know what? We have in the Financial Services Committee in Congress, we have California has two powerful people in that committee. Maxine Waters heads that committee. And just to bring back Glass-Steagall, Republicans and Democrats want to do that. They said that in their platforms. It's only 37 pages. They can just bring back the two proposals I mentioned. I recommend that we push them on that. It would make a huge difference. The also the there's a group called the Problem Solvers Caucus in Washington. Talk to them about it. That's what I suggest. Are there others of you have ideas on how we can get Congress to do this?
Hopefully, people will put some ideas in the chat then.
That would be great. That would be great.
So, question on the shadow bank repo. How has that affected our current housing crisis?
Well, it doesn't directly because it's the financing for financial markets. But the financial markets have greatly affected our mortgage markets because financial companies that require a certain amount of profit have become big players in housing. We used to have these little neighborhood savings and loans that's where we got our our housing loans. And now we get them mostly from shadow banks. So in an indirect way, it has influenced housing.
Thank you. What do you think about the lack of transparency and accountability among politicians? Without those controls, how do we keep them out of the pockets of bankers and others who hate the return of the regulations as you suggested?
Well, you probably know where I'm coming from. I rely on journalists to take care of that problem. And of course, we're losing our journalists. We don't have as many as we did. But it's traditionally been their job to ask the questions and to dig out that kind of money. So if you can support a news organization, please do. That's where we are most likely to get that information, right?
And does the legacy media report on any of this?
Yes, oh yes, but only in the business section. So my guess is that many of you, some of this may be new to you, but it's talked about all the time in Wall Street Journal, Bloomberg, Fox Business, and a lot of the Substacks that focus on finance. And in my document that I'm happy to send you are a list of, oh my gosh, 20 or 30 books. There's a lot of information about it. I don't know, people don't get it because they're not really interested in finance. And so journalists don't provide that information unless you actually go to a financial journalist.
It's not sexy enough, I guess, right?
I know people don't seem to care about it. I don't get it.
Um, what are your views on guaranteed income for low or no wage earners?
Well, I'm not going to recommend any kind of handouts in this work, um, because it's really clear to me that we need to get out of financialization, which has benefited the wealthy. We need to treat everyone the same. Now, I'm a business reporter. I'm not an expert on social issues, and I don't know how to answer that question otherwise. I'm sorry. Maybe some of the other people here can put their answers in chat.
And with that, I would like to encourage people to put some questions in the chat. We've had a few, but we do have time for a few more questions. So, lately there's been a lot of discussion about the billionaire tax.
Right.
Can you talk a little bit more about that?
Yes, I'm not encouraging that in my financialization work, because that's a part-time fix, a short-term fix. And regarding financialization, we need a permanent fix. So raising taxes on the rich for a couple of years is not going to fix this. We have to get permanent. We have to change this way of doing business.
That has to be something permanent, not just like you said, a short-term fix.
I know. I mean, that's a big problem we have in California already, right? So much
Hmm.
tax income depends on the wealthy. So when the stock market falls, our budget collapses. I mean, we need something that's stable and fair to everyone,
A question,
including the rich.
exactly. A question that came up earlier, and I'm not sure if you can address this or not, but the increase of AI affecting the workplace and potential job loss and how it would play into all this.
Well, that is something we're all focused on, right? We're all worried about. It doesn't affect the issue of financialization, except for the massive increase in wealth that it's channeling towards just a few people. Um, I, in my proposals, those people will pay quite a lot in Social Security and Medicare taxes, um, to be more equal with the blue collar people. Um, and I guess the answer to AI is I don't know where it's going. Does anybody else?
I don't think anybody does.
Maybe some of you work in that field. It'd be great to hear from you.
Um, I had another question that I think I just lost is um, a question about sales tax. So many of our local programs depend upon sales tax. And with the increase, especially after COVID, of online shopping, and we don't get that sales tax from that because it goes to the point of distribution. Any ideas on that?
Well, sales tax, of course, we all know it hurts people who have less money, because they have to pay those taxes too. But sales taxes are approved by voters. So I'm not going there. Uh, and to solve financialization, my approach is that Congress is the one that must do that work. Now, there's talk at the national level of doing away with income tax and replacing it with sales tax,
Hmm.
which sounds troubling to me, but sales tax are local taxes.
Yeah.
We can control that.
So, I think I don't see any more questions. And if you have any final words of wisdom for us as to, you've given us a lot to think about. And, oops, we have one more question. Do you think the stock market is currently overvalued? And if so, what is the percentage probability of another major correction?
I have no idea,
Okay,
but it sure is scary, isn't it?
it
It's
sure
just
is.
way up there. It really reminds me of the late 1990s when we had the telecom thing, and that's interesting because you remember we had the telecom crash in 2000, the dot-com crash. That did not cause financial market failures because we had not yet done away with Glass-Steagall.
Oh, that's good.
That crash was limited to the financial markets.
Hmm.
And I think a lot of people who own stock just wrote it down. A couple of years later, wrote it back up.
Yeah.
The thing that makes it different today are the points that I mentioned.
Mhm. Thank you so much for that. I hope we can all take it to heart and contact our electeds, and help make some changes.
Yeah, thank you very much for having me. I deeply appreciate it. I really do. Thank
Thank you.
you. And if people want to get my paper, what's the best way
So
to?
I've been taking down the emails that people have been putting
Oh,
in
okay,
chat,
thank you. Thank you.
so that we'll get those to you.
All right. Thank you so much. Thank
Sure.
you, everyone. I appreciate your being here very much.
Thank you. And with that, I'd like to just mention that our next hot topic program will be February 23rd at 11:30 a.m. I almost said p.m. At the new Register of Voters office, which is going to be out by the airport. Members, it will be a tour of that ROV site, and members from our league will give a brief talk about ways we help secure the vote. So hope you will see you all then. Thank you again, everybody.
Thank you.